Good afternoon, everybody. Welcome to September Cup of Joe. I'm Mike Carrazzo, content manager at Ryerson, and I'm joined, as always, by Nick Webb, our director of risk management, commodities hedging. Afternoon, Nick.
Good afternoon, sir. That's some beautiful art behind your shoulder.
Yeah, thank you. I wish I could take credit for it, but it's it's not mine. But trying to class up my background a little bit this month.
Love it. It's amazing.
So we're back live. We pre-recorded last month and had a pretty interesting discussion with our panel of experts. If you haven't seen it, check out our YouTube channel. But we're back live. We're here to take your questions. And Nick, got a lot going on. I think there's a jam-packed agenda here.
Yeah, unfortunately for those viewers, we basically just got you and I for the entire session. I don't anticipate it'll take the full hour, but we got a lot to talk about. The great thing about this being live is I was able to slide in a couple slides here that has not been approved by yourself or from legal. So going to be an interesting episode.
Yeah. Wonderful. All right. We always love those. So let's roll through them.
Let's go ahead and get into it.
Yeah. But before we do that, the first things first you'll see kind of a floating date there. I'm seeing two dates on my end. We're going to do Metal 101 again. So we did this last year on October 19th, but we're actually going to do it this year on October 25th. It's coming up in a few weeks here at 2 p.m. Central. And we just dropped the registration link into the chat window. So please note that it is October 25th. If you recall, last year we did this. We also did one on metal fabrication, but what it is we bring together our product managers. It's meant to give a 101 course on metal, how it's made, where it comes from, what the grades mean, what all those crazy numbers mean on the different grades, what's galvanized steel. And it's a really educational session. Angie Gomez, Brian Crane, and Mark Mooney from our product managers, I should say, side will be bringing us through. So if you're new to the industry, you got someone on your team that's new, just needs a refresher, I encourage you to sign up. That will also be live. So we'll take your questions along the way. So registration link in the chat below.
It's a great team. And by the way, speaking of live performances, the downside of doing this live is that when I go ahead and take your image and I make an adjustment, we end up with two dates on the screen. So that's fully my fault. I'll take the credit for that one.
No, it's the floating date over there.
Right. So
for Halloween, maybe.
That's right. That being said, let's go ahead and hop into it. But before we do, one thing I will not take credit for is the Chicago Bears. What you're looking at here is all of the teams down below inside the circle, inside the bubble. Those are all of the professional leagues. You've got up in the top left, you have the MLB, you've got the NBA down in the bottom left, got the NHL down in the bottom middle. Top middle is going to be NFL, and then MLS is over on the right-hand side. Those are all of the teams that in the last 12 months have won a game. And then you have the lone wolf out on the top right. The one team that has not won a game in more than 12 months is our beloved Chicago Bears, led by, unfortunately, coming from my alma mater, Justin Fields at quarterback. It's a sad state of affairs. I know we've got a game tonight. I'm not sure expectations are real high, but I thought viewers might enjoy this nice little stat that my analyst sent me.
Wow, that's pretty telling right there. Wow. Yeah, that's a whole lot of winning and one team who has it. And maybe the new bet is, with steel prices increase or the Bears win another game.
That's right.
Wow.
Yeah, it's incredible. I guess for any contrarian investors out there, maybe it's the time to get on board the bandwagon for the Bears.
No to Chicago here.
Yeah. Before we get into the content, as always, we are going to cover the legal disclaimer. These are the opinions of Nick Webb, Mike Carrazzo. These are not the opinions of Ryerson. Do your own homework. But we think we've got some great content here for you this month. So let's go ahead and get into it. First things first, as we often do, although I did change the layout just a tiny bit on this chart. Up in the top, I would say we have the most relevant countries for what we typically talk about here in North America and with regards to metals. So we've got the world, United States, Canada, Mexico, China, and then the Eurozone. And, going left to right, you can see that there's a lot of yellow. There's a fair amount of orange, and then you see some blotches of red over there on the right-hand side. And I would say, if I were to summarize those red blotches, it's predominantly going to be the Eurozone. So with the exception of the Eurozone, things look pretty stabilized. I know yellow isn't a phenomenal color when it comes to manufacturing activity, but in terms of the PMIs, anything yellow is basically plus or minus just a little bit on either side of 50, which is kind of stable. I would say that's a little bit of a different tune than what we've had over the last couple months. So we're now seeing China just north of 50. We've got the US just south of 50, but things are okay. I mean, I would say outside of Europe, they're okay. China's starting to show a little bit of enthusiasm. Nothing gangbusters. And then you've got Europe and many regions of Europe that looks like it's in recessionary territory. Pretty well confirmed at this stage.
Probably pretty early to factor any of the auto worker strike into this, right? This is
I would say so. And admittedly, even at this stage, only a fraction of the plants within the automotive space have shut down. There's a risk that if this continues on in weeks ahead, we may see that expand to other facilities. But yeah, that's a fair point. We're only about 2 or 3 weeks into the auto workers strike.
Yep.
Now, we talked about this last month, but it remains the case that we are in this kind of two-speed economy. This idea that while manufacturing activity is in slight weakening territory, we are still seeing services activity in a pretty robust state. The consumer just will not quit. I don't know if they're spending on credit cards or if their balance sheets are just that strong. But the consumer is certainly holding up the economy. And for those economists out there or anybody watching these podcasts, the services side of the equation does equate to about 80% of the overall U.S. economy. So if you were to combine these two and put a weighted average around the whole thing, we are still in okay territory, and actually even in growth territory. But unfortunately, on the manufacturing side, which is relevant for most of us here on this podcast, we are in slight weakening territory. But it's worth noting, there is a small uptick in the last couple data points with these PMIs. Now, last month, we did not do a live version. We did a recorded version. And unfortunately, after we recorded it, between that point in time and actually airing the podcast, we did get an updated data point with regards to the unemployment rate. If you recall from prior couple of Joes, the unemployment rate tends to have a very strong correlation as it moves higher to syncing up with recessions. Now, I'm not here to say that we are seeing enough of a move that we are going into recession, but I do think it's worth noting that ever so slightly, we have seen an uptick down there in the bottom right corner of about 30 basis points, so 0.3%. We went from 3.5 to 3.8 in the last month. The question we don't know is this beginning of a much bigger trend where we see more and more layoffs and the unemployment rate ticks higher and higher? Because as we know up at the top of this slide, if the unemployment rate tends to go higher by about 150 basis points or 1.5%, it tends to do a very good job of coinciding with a recession. And I think that makes sense. I mean, if people are losing their jobs, obviously that's a sign that the economy is softening. So we do get a new unemployment rate actually tomorrow morning on Friday. So it'll be interesting to see how that shakes out. As we sit here right now, the economists and expectations are that it's going to be basically flat. It's actually, the expectation is it's going to slightly improve, which would basically keep any sirens off with regards to this turning into panic mode. But we'll have to I think we'll definitely want to keep an eye on this. But I wanted to highlight that because we did touch on that last month, but because it was recorded, we got the data point just subsequent. The good news is as we look at the Atlanta Fed GDP Now Index, which what the Atlanta Fed is doing is they're taking into account new data points as they come in and using that as an intra-quarter estimate to give us a look into or a preview into what GDP looks like it's tracking. And as we sit here right now, it has come off the high levels close to 6%, but we're still running based on the most recent data that's feeding into their model right around 4.9%. Now that's a really robust number, as you can see, looking back over this 1 year history. Most expect that this number is going to creep lower as we get more and more data points throughout the quarter, and it's going to creep down into the 3 to 3.5% range. But again, make no mistake about it, those are pretty good numbers when we think about GDP growth of 3.5%. So again, I do think that we do have this situation where the services economy and hospitality, travel, leisure, things like that really is holding up quite well up to this point. Now, the issue with that, and we've talked about this in the past, is that is a bit of a thorn in the side for the Federal Reserve, who is actually trying to cool off spending, cool off the economy. It's proving much more resilient than I think most had expected up to this point. And this is just one example of that. This is a historical chart going all the way back to the 1960s, showing an estimate of who is intending to take a trip outside the country in the next 6 months. And you can see we're essentially at all-time highs. And so this is just one of those instances of people seem to, whether they're putting on credit cards or whether they're just feeling wealthy for whatever reason, wage increases, they are feeling good about traveling abroad right now. Now, part of that might be we are seeing a stronger dollar that's helping to make foreign travel a little cheaper on a relative basis. But this is a pretty staggering chart showing the strength of the consumer here in the United States. Now, on the flip side of that, the issue with the consumer being as strong as it is, and the services economy being as strong as it is unfortunately the Fed and interest rates probably aren't yet done causing the pain. And we can see that evidence here in this chart. So I'll run through a couple of these real quick because each one's going to have different applications to how it impacts the cost of money. We'll start at the very top, the purple line. That's going to be the 30-year mortgage rate. So that is bankrate.com. That is their national average of where they estimate the 30-year mortgage rate to be. That rate about a year and a half ago would have been closer to about 3%. We're now running 7.88%. So I ran through this earlier this morning with my analyst. There's an estimate that basically says in 2021, 2 years ago, if you try to buy a $400,000 house and you take into consideration all of the interest expense that takes place over a 30-year mortgage and you pay down, you pay off your house, all in that equates, I think the number was right around $650,000. I'm giving rough estimates, but a $400,000 home after interest after 30 years is about 650 grand out of pocket. Now, fast forward to today, a $400,000 house purchased on current mortgage rates over a 30-year period is about I think it was $1.03 million. So that just gives you an idea of how much more expensive over a long period of time, sure, but just dollars out the door are required to purchase a home right now. So that's the type of impact that this can really have on a housing market. We've got the white line just working our way down. The white line is going to be the SOFR rate. So that is basically the rate at which, or it's a benchmark to which corporations can borrow money. And you can see that rate for 2020 through 2022 was basically 0%. So then corporations would borrow off of some spread off of that rate. It's now all the way at 5.4%. So the cost to borrow for corporations has gone up very substantially. And then the other two, so we've got the orange line, which is going to be the 30-year just interest rate. So that's not the mortgage rate, that's just 30-year treasury yields. So that's the rate you can get from lending money to the government for 30 years. And it's right around 4.87. And then lastly, probably a little more applicable for borrowing money for maybe a car, let's say, is a 5-year treasury. 5-year treasury, that's usually the duration to which somebody would take out a loan to buy a vehicle. And that rate has similarly gone from right around 0.5% to 1%, all the way up to close to 5%. So the point of this slide is really just to say that the Fed's work, unfortunately, doesn't seem to be done yet. Inflation hasn't yet gotten down to the target. And the cost of accessing money, so wealthy people don't really have to worry too much about this because they typically don't have to borrow too much. But anybody who has to borrow, whether it's a government or whether it's a corporation or whether it's an individual to buy a car or a house, it's getting much more expensive in a fairly quick way. So these are all of the unfortunate side effects of trying to cool off inflation as we roll through the last.
So Nick, on the corporation, their average is usually, if I read that right, is like maybe 2.5% to borrow.
Yeah, I mean, if we're using the 5-year historical, yeah, that's fair.
Yeah, and Speaking to a friend who's a realtor, we talk a lot about the interest rates and the mortgage, and he always says, once things do drop a little bit, then you have all these people that have been waiting on the sidelines that kind of flood the market. I guess is similar happen on the corporation front. If they can't, are they kind of waiting in the wings to purchase? And I guess does that flood have any kind of impact on the market if they all come flooding back?
It's a fair question. I think on the corporate side, it's a little more complex than just saying it's one size fits all. I mean,
Yeah.
some corporates rely on debt in a very heavy way. Certainly, manufacturing is much more capital intensive, so it could impact spaces like that a bit more. The startup space, they tend to rely a lot on equity money. But if they had to go out and tap the debt markets, it's going to be much more expensive to do so. So this could, on the corporate side, what this risks is, as it gets more and more expensive to access funds, and I would say that really across the board, it could speed up the risk to which, if a company was hanging on by a thread,
Yeah.
the speed at which it drops off that thread or goes bankrupt or has to default on a loan probably speeds up. You mentioned the piece on the mortgage bid, or the realtor conversation. Interesting phenomenon going on within the housing space. I think anybody who took out a mortgage over the last 10 or 15 years probably has an interest rate on a 30-year mortgage somewhere around, let's say, 2.5 to 3.5%, basically half the current market rate. What we're hearing, what we're finding, and I think it makes sense, is if you've locked into a home and you're on a 30-year mortgage, unfortunately, that mortgage does not travel with you when you move into a new home.
Cool.
So what we're finding people doing in a very big way is they're just staying put in their homes and no transactions are going through. So I've been anticipating that housing prices would come down because that's the only way to really make these homes more, a little bit more affordable in the face of higher interest rates. But I think what's happening is a lot of people who are in homes just aren't moving. There's no transaction going through because they don't want to move into a 7.5 to 8% mortgage in that new home. Because apples to apples, you're basically saying you get a similar home, but it's going to cost you double the cost, or something along those lines.
Absolutely.
Yeah, yep. Very weird phenomenon right now. Now, we don't normally have themes for Cup of Joe, but I saw this one from Goldman Sachs a few weeks ago, and I thought it was a very good one. I'm a big fan of alliteration, and I wanted to touch on this as we head into Q4. These are some pretty important topics that look like they're going to cause a little bit of a headwind on top of what already looks like headwinds from interest rates going higher and the Fed really trying to cool off the economy. So student loans, shutdowns, and strikes. Oh my. We're going to hop into each one of these in a little more detail, talk about what those implications are for Q4 and maybe a little bit into next year. So let's go ahead and get into those. So first things first, I know we talked about this in last month's Cup of Joe, because September was the month in which the interest accrual was going to begin for student loan payments. For those who don't know, for the last basically 2.5 to 3 years, student loan forgiveness or student loan debt was forgiven in the face of COVID and lockdowns. A lot of people lost their jobs, so they weren't able to pay off their student loan debt. Well, that has ended, and as of September, the interest has begun accruing again, and starting in October, so this month, the payments are going to begin. And as you can see in this chart, and I don't have the scale over on the y-axis, but that is $1.6 trillion of student loan debt that's been accrued over the last several decades. I don't know the exact number per borrower. It's going to be different depending on where they went to school. But the estimates are certainly in the $400, $500, $600 per borrower per month that could be kicking in. So that's $400, $500, $600 that somebody may be earmarked for traveling to Europe, as that prior chart had shown, that maybe they have to allocate towards interest on their student debt, which is basically a black hole. It's not really a productive thing. It's it's just spending money to service debt to make sure you don't default. And so that is going to take out a piece of this consumer spending. Might only be a couple $100, but to many people, a couple $100 can make a very big difference, particularly in the face of this inflationary environment where food and energy and electricity is all much more expensive than what we've seen in prior years.
I'm going to say that's probably why in your earlier chart everyone's leaving the country, taking that one last trip.
That's fair. That's fair. You can get a much cheaper meal over in Florence. Second is government shutdowns. Now, I was contemplating not including this one because, for many of you may know, last week they did actually get an agreement on not shutting down the U.S. government, which kept the ability to pay people like the TSA, postal workers, things like that. But that being said, we have had some very recent developments, and I don't want to get too deep in the political woods. But just a couple of days ago, the Speaker of the House was voted out. And the only reason why I say that is worth noting here is because it does look as though, given that situation, the negotiations for any upcoming debt ceiling discussions probably gets a little more contentious. And unfortunately, this measure that they passed about a week ago, it was only to get them through spending for the next 45 days or so. So the expectation is once we get into, I believe it's November 17th, they're going to have to come to the negotiating table again. And this time it might be a bit more contentious. And so estimates are out there that we're probably going to see, a lot of infighting, a lot of political rigmarole, I'm sure. And but this chart ultimately shows the nominal value of the U.S. federal debt, and those are in, let's see, that's in millions. So that's going to be $33 trillion worth of debt here in the United States. And you can see it continues to rise at a clip of about, I think it's about 2 trillion per year. So it's certainly rapidly increasing. It is something we want to keep an eye on. That's about where I want to leave it because I don't want to get too political in terms of whether or not debt is a good thing or a bad thing. But I will say in terms of spending, because when we think about GDP, government spending is one of the items that comprises the GDP composition. So if the government is shut down for a week or 2 weeks, or God forbid, something longer than that, that is government spending that is going to feed into a weaker GDP print. And we'll get into those details here in just a couple slides. Mm-hmm. Now, what we're looking at here is going to be a little bit of good news, which is, yes, we are seeing debt levels rise, but the good news, a little bit of an offset to that, is we are also seeing GDP rise. So I want to make sure I give a little bit of a balanced story of this isn't just taking on more debt, and we're not growing as well. We are growing as a nation in terms of GDP. Now, some of that is due to inflation, but that being said, GDP since 2000, let's say 2019, it's up about 23-24%. So that should help to cover our bills and our interest expense as a nation. The unfortunate thing is shown here in this chart, which we already talked about: student loan debt and student loan interest. This is the interest on government debt. So this is basically taking that $33 trillion, applying some interest rate to it, and it currently equates to about $909 billion. That's with a B. For those who don't know, to put it into perspective, the entire U.S. defense budget is right around $850 billion. So as it stands right now, the government is spending more on servicing its own debt than it is on defending the country. And again, I don't want to get into the woods on whether that's a good thing or a bad thing, but it gives you an idea of how big this debt burden and the interest burden affiliated with it is. Now we're getting a little bit in the math here, but if you do the quick math, you may say, well, Nick, didn't you just tell me that interest rates are 5.5% and that the debt is $33 trillion? Well, if you ran 5.5% against $33 trillion, that equates to something much bigger than $909 billion. The reason why it's only $909 billion is because some of this debt was taken out in past years. It may have been taken out in 2010, 11, 12, when interest rates were much, much lower. So the weighted average cost of the U.S. debt right now is right around 2.7%. So you take that 2.7%, you apply it to $33 trillion, and that's how you arrive at this number. The bad news in all of this is if this number keeps going up, which is the overall debt level, the notional dollar value of debt, if that continues to go up and you have interest rates continuing to stay elevated, that's going to increase not just the dollar amount of debt and thus the interest rate as well is going to add on to that effect. So again, the quick math would be, if we roll through time and interest rates stay elevated where they are, the cost of the government to borrow gets more and more expensive as well. And that number could creep above $1 trillion in the not too distant future. So it is something that probably needs to be addressed, probably need to have a better solution than revisiting this equation every 45 days. But again, I'll leave it there because I don't want to get too deep into politics on this. But it is, from an economic standpoint, every time we lock down the government, it is impacting spending in total. Now, it wouldn't be baseball season in October if we weren't talking about strikes. And right now we are sitting in a situation where we've got a lot of them. Some of them are much more highlighted than others, and some of them much more directly impact our industry than others. But I went to NerdWallet and pulled up a summary of all the current active strikes that are taking place, and also some of the ones that are being contemplated. And there's some pretty big ones out there. Obviously, up at the very top is the one that's on the front of everyone's mind within the metals world, and that's going to be the United Auto Workers strike. So as it stands right now, we've got about 18,000, 19,000 people that are currently striking. There is a risk that could expand if these negotiations continue to be contentious. It could go all the way up to 150,000 individuals. Now, unfortunately, at least as I understand it, 150,000 isn't necessarily the ceiling on how painful it could get. There are knock-on industries, there are tangential industries that need the auto business to be working, thriving, and productive in order for their businesses to maintain. They need to have employees. And already we've seen some tangential businesses say, if this is going to be shut down, certain assembly plants have to close down, certain fabrication shops have to shut down. So there are knock-on effects, and there might be big debate on how large that knock-on effect is, but I've seen some estimates that it's about 5 to 1, meaning there are basically 5 to 6 jobs that are tangential to the auto industry that rely on the auto industry actually functioning. So that one's certainly a big one. Now, I'm not going to go through all of these, but we've obviously got the Screen Actors Guild, Hollywood, and its writers are both striking. Although the Writers Guild looks like it's been resolved in the last week or so. Just in the last couple of days, we've got this situation with Kaiser Permanente, which is a big healthcare organization. It's about 75,000 individuals. The point of this slide is really to say a couple of things. One is all these strikes, again, whether we agree with them or disagree with them, they do tend to impact productivity. So there is an economic impact to them for sure in terms of productive output. There's also an element of some of these, if they get negotiated and it goes in favor of the union, they could be inflationary. If you think about the auto workers, demanding a 30 or 40% pay increase, and again, I'm not here to say whether or not that's good or bad or right or wrong, but 30 to 40% pay increases, even if it is extrapolated over 4 or 5 years, that would outpace the current pace of inflation. So those wages tend to be sticky. Those wages tend to impact inflation. And so this could have kind of a two-pronged impact on the economy. We'll have to see how all of them play out. But certainly there's a direct impact to the metals industry and to the steel industry where, the longer they're shut down, the more impactful it could be to steel demand here in the United States.
Now, as the color coding is red, the strikes have happened, blue, like potential, and like gold have been resolved.
That's exactly right. Thanks for pointing that out. Yep.
Okay.
Yeah. So down at the very bottom, you've got, the bartenders out in Vegas are thinking about striking. They haven't done so yet, but there is risk that, I think this is my personal opinion. I think when you see headlines of certain unions striking and you're sitting in Vegas and you're in the hospitality business, it probably beholdens you to really, think about yourself and consider your own strike. So these things can be cumulative in nature, I think, as they get publicized. Now, this is really the summary slide. This is the one that kind of prompted the whole theme, and this is coming from Goldman Sachs. They put this out just a couple weeks ago. It's really, what does it all mean? You're telling me all these things are happening. There are going to be some speed bumps. How are there going to be speed bumps? Well, if we put pen to paper and actually do the math on all these things, the resumption of student loan payments, basically that couple $100 per month that may have to go away from buying a new pair of Nikes or a trip across the pond, it's going to have to go to interest expense. And the expectation is that could impact GDP in Q4 by about 0.5%, so 500 basis points. Or I apologize, 50 basis points. The government shutdown, for every week it persists, and again, they resolved it the last time about a week ago, but the expectation is that here in 45 days, they're going to be back into it. Goldman Sachs' estimate is that it's going to take about 2 to 3 weeks, which in total would be about 0.5 to 0.6% in addition to the student loan repayments. And then thirdly, we're already 3 weeks into the United Auto Workers strike. for every week that this extends, Goldman's estimate is that it impacts GDP by about 0.1%. So as we sit here today, 3 weeks into the strike, the expectation is that will be another cumulative impact to the downside to GDP. And so right now sitting right around 0.3%. You add all these up, it just adds a little bit more of a headwind to what, in my opinion, looked like, an economy that is trying to be put back in its place and slowed down by Jay Powell and central bankers, and not just here in the United States, globally. I would say central bankers are really trying to bring down inflation. So I think the moral of the story isn't sky is falling. It's that the headwinds that already existed that we've talked about ad nauseum, they probably get a little more compounded because of these factors. Now, the good news is these factors are temporary. This too shall pass. But it is additive, unfortunately, to some of the economic impact that we've been talking about in the last couple of months.
Yeah.
Now, that being said, I don't want to be all bad news. I don't want to tell you that everything's coming crashing down. And what's interesting is, even in the face of all of this, and viewers may be surprised by this, we are a metals podcast. We're going to get into metals and what metals prices are doing. Metals actually, in some cases, look like they may be bottoming and seeing a little bit of growth in the coming months. So let's go ahead and hop into that. So on the steel side, we always run through this 5-year chart. This is going to be showing U.S. prices in the white. The blue line is going to be Northern Europe, and then the orange line is Chinese prices. And you can see that there's a large amount of convergence between these three markets. We are now, so this is the front month futures contract for steel prices. In reality, the CRU, which the CRU mostly sets the physical prices for North America, it's actually down at 663 right now. So it's a little off, but it's generally giving you the right idea on trend. But the spread between European prices and the U.S. has converged to its tightest levels in at least a year, and we're certainly getting back into price ranges that we really haven't seen for an extended period of time since pre-COVID. So pretty interesting stuff going on here. But that being said, as we look forward and we look at what the market is expecting things to do in the coming months, and again, this is all in the face of the United Auto Workers strike. The expectation is that as we roll through the next few months, steel prices are expected to move higher, not just move higher by a little bit. Based on the current futures market, as we roll into Q1 of 2024, the expectation is we're going to see prices higher by about $150 to $200. Now, how in the world does that happen? Well, the first one is the U.S. mills. They have found themselves in a much more consolidated state now than where we would have been in the last 5 or 10 years. So they do have the ability to pull some levers to, when they see auto workers and auto plants striking and shutting down, they can do maintenance. They can shut down their own mill. They can mothball it. They can do a temporary maintenance. And we are seeing that in a fairly big way. Just in the last couple of days, we've seen Granite City shut down Blast Furnace B, which is, I think, about 1.4 million tons. We've heard about Lake Erie Works, which I believe is 1 to 2 million tons. We've got Gary Works, which just in the last 48 hours has announced that it's going to do a temporary maintenance. And then the last one is Steel Dynamics down at their Columbus facility. They were going to have planned maintenance in November. They actually had a fire in the last couple of days, and so they're bringing forward their maintenance to current. And a lot of these maintenance durations are expected to be 2 or 3 or 4 weeks. And if you were to annualize the tonnage that all 4 of those produce, you're probably talking 8 to 10 million tons of annualized production. So there is a chance that even though we are seeing demand destruction from the auto strikes and those knock-on effects, the supply side of the equation does appear to be getting ratcheted the opposite direction and may actually keep things tighter than we would have expected just a couple months ago. And that's really what the market is saying, is that there's an expectation or a hope in the market that, again, the auto workers strike, this too shall pass. We don't know if it's going to be a week. We don't know if it's going to be 2 months. But at some point, the expectation is that, and I would say Ford is on the forefront of getting some negotiations done, and that may clear the way for this resolution. And if that happens, you may see a lot of bottom ticking or a lot of bottom feeding amongst consumers and service centers alike to say, hey, $650, $700, these are pretty good numbers. Let's load up on some tons and have it ready for next year. And if that happens in a big way, you could see lead times push out. Now, again, is some of this a little artificial in nature? Yeah. I mean, I wouldn't say that demand in the US is going gangbusters. And I wouldn't say it makes total fundamental sense to see steel prices back at 1,000. But if domestic mills do a good job of keeping production constrained, and this next chart kind of shows a little bit of that, although it's not fully baked in yet, the U.S. mills can use their own production, rein that in, do idlings or mothballs or maintenance, and they can keep the market balanced better than maybe what we sometimes give them credit for. So again, I don't think fundamentals, if everybody's producing steel at the same time, I don't think fundamentals support a massively higher price. But it does feel as though we are in a bottoming process, even in the face of the auto workers strike as we sit here today.
Yeah, I guess I never realized just how much, no pun intended, that the auto industry drove the steel market. I think Brian Crane said that pun last month, but I saw some estimate that the big three automakers consume a little over 400,000 short tons a month of steel. Does that seem accurate to you?
Sounds right, and might even be a little light. Yeah, I mean, the auto industry in the United States is roughly 20 to 25% of end consumption of steel. And for every car produced, you're talking about 1 ton of steel. So if we're running it, and this wouldn't just be the big three, or sometimes what they call the Detroit three or the Michigan three. If you just look across all the auto industry and you assume seasonally adjusted auto sales, I think are right around 15.5. That would, 1 for 1 to a ton of steel would give you about 15 million tons of steel. So yeah, I would say that number might even be light.
And this, maybe going off, but like, do other, like, we'll call it like tangential industries to the auto, like does it impact like construction equipment or things that are, other vehicles that, you're talking construction, agriculture, things like that? Would they see a slowdown as well in steel consumption?
I think less so in that case, unless you've got, some of those pieces of equipment that are required to move things around. I would say unless you have something like that, typically not. And admittedly, I would say within the construction space, we're actually seeing a little bit of optimism right now. And a lot of that, admittedly, is going to be coming from the government policies related to, the CHIPS Act and infrastructure bill, things like that. So I would say that the construction, this wasn't exactly your question, but I would say the construction industry is actually helping to blunt the downside a little bit because it's actually running decently hot right now.
Makes sense. Okay.
Similarly, on the aluminum side, while again you might expect the auto shutdowns to really impact aluminum demand as they relate to putting aluminum in cars, but worth noting, Tesla, who uses a lot of aluminum in the exteriors of their vehicles, they are not currently unionized. Or again, right, wrong, or indifferent, they are not currently unionized. So their auto production is not actually all that impacted, and could probably make the same argument for many of the EV producers. And admittedly, over the last couple of weeks, we've actually seen a little bit of an uptick in aluminum prices on the London Metal Exchange and on the Shanghai Futures Exchange. And some of that is coming out of small bits of optimism out of the Asian market. In the last few weeks, we are getting word that outside of the property sector for China, which we've talked about a lot in prior couple of Joes, their property sector is still struggling at this point. It's down roughly, let's say 7 or 8% on a year-over-year basis in terms of investment. They've got other things like infrastructure into higher technology products and green energy, renewable energy, whether it's wind farms, solar farms. Their growth rates are pretty staggering, and a lot of these projects are consuming large quantities of copper and aluminum. And it's not much. You can see that in this chart. It's not a big uptick, but we are beginning to see this horizontal line of support, which is right around 95 cents, let's say. That it's kind of acting as a support level right now. Again, some of these are a little bit of hocus pocus, but there is a fundamental reason that, as you get lower and lower on the price of aluminum, at some point you start digging into the cost curve. And I would say that right now it looks like some of that cost support does exist in the mid to high 90-cent range. You can see we bounced off that area a couple times, and we're now moving above a couple of the key moving averages. Not in a gangbusters way. I don't expect to see record high prices in the coming months, but it does look like there's a little bit of optimism And I would say most of that optimism is coming out of the Asian market as it exists right now. And that's something we really haven't talked about too much is small bits of optimism coming out of Asia. And as we all know, Asia, when they flip the switch back on, and I don't think they're going to stimulate their economy the way we've seen in the last 2 or 3 decades, but they are certainly seeing some growth in some higher tech areas, and that could provide some support because China's 50 to 60% of global aluminum demand, steel demand, copper demand. When they're coming on, they'll have a very significant impact on the demand side of the equation. There's no doubt about that. And this is a chart showing. We sometimes show this chart. This is the money manager's positioning. So this is basically how bullish or bearish are traders, hedge funds, investment community. And you can see in the last couple of weeks, traders have basically flipped from a net short or bearish stance to a net bullish or positive stance in the last couple of weeks. A lot of times traders, whether we like it or not, they can move markets, they can push prices around, and it does look like that's the case right now. So traders appear to be watching some of the things that we just talked about, which is in small elements, Asia's actually doing okay. On the Midwest premium side, it's mostly a continuation of the same thing, where in the white line, we're seeing premiums continue to mostly just kind of bleed lower. I don't think we have a ton of downside from here, given the fact that we have tariffs and things like that keeps a little bit of a bid under these Midwest premiums. But overlaid against this, as we've shown in the past, is the truckstop.com freight demand index. And, it's not a perfect correlation, but, overlaying this against the premium chart, I would say we're somewhere around a happy medium for prices. So I would expect we'll see some stabilization, plus or minus a couple cents either side of 20 cents. So kind of boring on the premium front, but I think boring is probably a welcome thing at this point for many consumers. Got a lot of squiggly lines on this chart, but this is the chart of nickel, and nickel, as we all know, has big impacts on stainless steel surcharges. This is the one exception to the rule within metals, I would say, at least for now. This can change. But nickel, unlike steel and aluminum, it seems like every other day we come in, it's just continuing to bleed lower and lower and lower. Some of that I think makes fundamental sense. Some of that is due to the fact that within Indonesia, and we've talked about this in prior Cup of Joes, there's an expectation that a lot of class 1 nickel and a lot of nickel pig iron is going to be coming online in the next 12 to 15 months. That should better supply the market, even in the face of what looks to be a continually growing EV market. So for now, it looks like it's a fairly well-supplied market. Stainless steel is fairly well supplied globally. I would say here in the United States, we are seeing a lot of import penetration still from the Asian space. So stainless is of the 3 markets, certainly the one that's under the most pressure. All the squiggly lines, I've drawn in this horizontal red line, which is kind of just it's basically acted as a ceiling to prices. Every time we bumped into it, it's kind of sold off at that point. And then the green line is sort of the bottom end of that channel. You can see it's kind of shooting for right around $8 a pound as we sit here today. From a technical standpoint, going all the way back to early 2021, it's not really until you get down close to $7 per pound that we really find any bit of technical support. And technical means nothing more than like charting support. So it's kind of a sociological way to look at prices. But sometimes traders, use those, and they do matter to a point. But fundamentally, the story is really just that whether we're talking about stainless steel or nickel, both are fairly well supplied at this state. And when we think about cost support, where is that level to which a nickel miner might say, I don't want to produce any more nickel because I'm not making any money. Even at 850, plenty nickel miners are making money. So it's not really until you get down probably below $7 a pound that you start digging into that cost support, and miners start saying, this project really isn't all that viable anymore. Let's shut things down and wait for a better day for prices. So this is the one exception to the rule on the stainless and nickel side. And you can see that evidenced when we look at the money manager's positioning. It's ever since March, you could call it May, we've really seen a downward trajectory in the positioning of traders. So what that means is they're getting more and more short or bearish the market. And again, I would say a lot of that's based on the factors that we've noted, which is it's becoming a much better supplied market as we sit here today. And this is the other factor. So this is going to be looking at LME nickel inventories. We've talked about the London Metal Exchange ad nauseum over the last year and a half and all their faults and their issues. But in the last couple of months, they have started to take some steps to try and bring a little bit more legitimacy back into the space. And one of the things they've done is they've begun fast tracking new producers of Class 1 nickel who can then take some of that nickel and put it on the exchange. Well, in the last couple of months, really the last 30 to 45 days, we've begun to see inventory levels at the London Metal Exchange move higher. It's not massively so. We're certainly not back to the levels we were at earlier in the year. It's still tight on the exchange. And again, this is Class 1 nickel. Class 2 markets are still pretty loose in terms of supply demand, but you can't deliver Class 2 onto the exchange. So we are beginning to see this the London Metal Exchange heal itself, and inventories are becoming a little more prevalent, and that's obviously acting as a little bit of a headwind on price as well. And then last but not least, we haven't talked about chrome too much recently, and there's a reason for that because it's actually been quite boring. There's a little bit of movement intra-quarter, but we just got the new quarterly reset for the chrome price for Q4, and it reset 3 cents higher. It went from I apologize, 2 cents higher. Went from 151 to 153. I call that flat. So there isn't a whole lot to report, but since we got the new data point for Q4, I figured viewers would want to know where that landed. Obviously, I do want to know up here, you're seeing the 325. It's a different index than what the mills use to set their surcharge. But generally speaking, I like to use this to give me an idea of intra-quarter where we think it's going to land. So this is a South African chrome index that I use that I pull from Bloomberg. But up here above, you can see the price 153. That's where the chrome index reset. But with that's really what we've got. It was a lot of blabbering from Nick Webb. Hopefully, we've got some questions coming in that we can address.
It's never blabbering, Nick. You're on a roll.
It's sometimes blabbering.
No, we got a few questions coming in, but before we get there, you had mentioned about the the miners in Indonesia with mining for nickel and the profitability of that. And it triggered you talked in the past about the aluminum producers kind of in the same boat with the high energy costs, maybe making it, is that kind of still a threat right now for aluminum producer refineries in Europe, I believe?
Yeah, so we're beginning to see, and I might get myself in trouble saying this, but we are beginning to see a little bit of a trend of what I would call reversing the renewables theme, or reversing sort of the ESG, the environmental side theme. What I mean by that is, to your point, some nations, some regions have started to find that energy costs are becoming cost prohibitive, and it's making it really hard to make a wind farm. European wind farms right now are actually having a lot of trouble in making those and getting those projects done in a profitable way. The reason why I bring that up is because we are beginning to see some projects taking nickel pig iron and turning it into Class 1 nickel. We are seeing some people bail on those projects. The reason why one would want to consume Class 1 nickel versus nickel pig iron is that nickel pig iron tends to be more pollutive. Class 1 nickel, tends to be a cleaner product, and people feel better using it in renewable projects. We are seeing a little bit of that reversal in the trend where people are kind of saying, if push comes to shove, why don't we take the cheaper product? And even though it pollutes a little bit more, we'll use it. So I don't know if that fully answers your question, but we are seeing some early signs of that. And as an example, just in the last couple of days, Germany, who, as I mentioned, Germany's having a lot of economic woes right now. They noted that they are going to ramp up their use of coal this winter. So kind of going backwards, again, I don't want to get too deep into politics of all this, but it is kind of going backwards in terms of these environmental strategies. I think they're realizing that, or thinking that maybe they moved too far too fast, and they were trying to reload a little bit.
Makes sense. Yeah. Well, your public awaits. So we got some questions lining up here. The first one, in August, Mexico imposed a 25% tariff to Asian steel, aluminum, stainless. Has that been affecting prices of these commodities at all?
Not in stainless, really. I mean, I do think we'll see a little bit of a move lower in terms of the volumes that are being imported into North America on stainless. But as I understand it, import volumes are still quite I would say, attractive on a pricing standpoint. Obviously, the lead times are tougher, and the U.S. there is a risk that the U.S. follows suit with not just Mexico, but follows suit with Europe on tariffs with regards to stainless. There are actually many who think that that is the base case, that Europe is really kind of laying the groundwork for what the U.S. is ultimately going to do. So that those things would ultimately help to wall off some of these and create a bigger risk of bringing in foreign product. But up until this point in time, I would say imports are still coming in North America in a fairly big way.
You had mentioned the chips and infrastructure projects. Do higher interest rates create any demand destruction in projects as it costs more for everything related to these projects?
Yeah, for sure. I mean, and not just government related projects. I would say any project, if you're doing if you're doing a cost benefit or just a, present value of the project, and you were using any historical rates from the past 10 or 15 years, you probably got to double that interest rate, which could really impact these projects. And I mentioned the idea of the wind farms in Europe. If you pull up some of these stocks of the wind farms, they're down 50, 60, 70% in the last couple of months. And I think it's because they're finding that the cost of doing them is getting a little prohibitive. And I hate to say this, but that is kind of the point of higher interest rates, is it really is to make things like buying a home, buying a car, doing a project a little more prohibitive. I mean, the central banks are trying to soften this situation a bit.
Okay. And I'm glad a viewer brought this up. And actually, Nick, I'm surprised you didn't have a slide on this. Shame on Nick Webb. As you know, that the automotive industry not only consumes steel, right, but they produce a lot of scrap, and scrap is the biggest contributor to steel. I learned that from you, Nick. If the auto strike is extended, what impact is it going to have on scrap prices and steel prices?
Yeah. So in the last month, we did see a move lower. So from, let's say, August to September, we did see a move lower in certain grades of scrap. But the expectation is, as the viewer noted, with less auto production, you get less scrap generation. That could tighten the scrap market as it relates to steel producing. And I would say we are beginning to see some stabilization of scrap prices right around the low to mid 400 range for the higher grades of scrap. And that in addition to a couple other things I talked about on the steel slides, that in addition is helping to put a little bit of a floor in how low steel prices ultimately go. And I would actually probably I will go on the record as saying, at least over the next 3, 4, 5 months, I do think we are seeing the lows of steel prices right now, and probably could make the same argument for scrap as well.
Okay. Question here about Asia, with the Asia trend increasing, and I don't know exactly what Asia trend, but the high level of inventory in LME warehouses. What are the trends you're expecting through Q4 2023 and into 2024?
So the trends, I would say the trend would be that Europe is beginning to show a little bit of strength. And as that relates to base metals, I would say that it should be a little bit supportive. So while we may, like I said, I think Europe is already in recessionary territory right now with PMIs down in the low 40s, high 30s. I think Europe's there. US, in my personal opinion, I think there are probably more headwinds ahead of us in the next 3, 6, 9 months than there are tailwinds. I don't know whether or not we're going to go into official recession or not, but we may see a slowdown here in North America as well to a degree. But I think China's strength just helps to offset or dampen some of that impact to base metals prices. And I think that's evidenced when you look at things like aluminum, where even though demand in Europe and partially in the United States it's okay at best, maybe slightly weak, we are seeing prices move higher, and that's the kind of power that China, when it comes back to the market, it can have on the price of commodities.
Makes sense. I think you answered this by saying, what you think about the price of steel, but the price impact of the strike was pretty much priced into the market a few months prior, right?
I would say so, yeah. I mean, if you take prior strikes as a proxy for where this one ultimately is, I'd say it looks up to this stage almost identical. Prior strikes on average, that you tend to see a steel price move down about 15 to 17%. And then within a couple of weeks of it getting resolved, you usually see a rally of 15 to 17%. It gets you basically back to the same starting point. with steel markets and financial markets trading the way they do these days, yeah, I would say that a lot of this was already priced in. So that move, the move of hot roll, maybe going from 800 down to, we'll call it 650, which I would say is right around the bottom. I would say that was the move, and a lot of that happened even before the strikes even took place. And that's because everybody and their brother within the steel industry was out in Atlanta, and it was pretty much a sure thing, as Brian Crane first mentioned on Cup of Joe just a month ago. His takeaway was these strikes are not an if, it's a when. And once that becomes essentially a guaranteed phenomenon, the price dwindles. Now the reverse is also true. I think the futures are kind of telling the story that futures are already looking through to the other side and saying, we're going to get through this. Ford already looks like they're putting together a pretty good proposal. I think, again, I'm not an expert in these things, but looks like they're at the forefront of these negotiations. And if and when they get that resolved, we should see something look sort of like a reversal and heading back towards an 800 type pricing. And admittedly, we are already seeing domestic mills, even though it's not reflected in the CRU. If you went to a domestic mill today and said, hey, sell me that 650 steel that Nick Webb was talking about, they won't do it. That's not where the price is anymore. So whether they had to announce a price hike like Cliffs did, or whether it's just they've raised their price book behind the scenes, it's already on the upside. So there's some optimism built in there.
So things like this are typically priced into the market, right? I mean, there's not obviously a knee-jerk reaction. I mean, these things, like
you said it in a much more succinct, accurate fashion.
Yeah. There's a few questions coming in, kind of all around the renewable energy, some of the potential issues you had noted earlier. Do any of these issues with renewable energy projects around the globe? I guess what impact does it have on the metals industry on whole?
So I don't want to get too deep in the woods on renewables, good, bad, right, wrong, or anything like that. But directly answering that question, some of these wind farm projects use large quantities of plate steel. All those towers are made out of carbon steel. So, yeah, there were, and I would say if you talk to, what was it, a couple months ago, we talked to the chief commercial officer of Nucor, who runs plate and sheet, and he had mentioned that one of the industries he's seen as being extremely hot, at least at that point in time, was wind farms. And if something or a project were to go the opposite way, I would say the impact to metal would be similar. So it could be impactful. Yeah, that's probably how I would answer it most directly. That these projects, I mean, a lot of renewable projects are much more metals intensive than historical traditional uses of energy. So if those projects were to reverse course, or people were to pump the brakes on those types of strategies, it could change the trajectory of metals demand. And not just, these aren't 1, 2, 3-year projects. Some of these are 5, 10, 15-year type themes.
Sounds good. Yeah. I'm going to throw 2 more here at you. Real quick, what are you seeing for future volumes of stainless imports coming into the U.S.? Yeah, I think you mentioned a little bit of that earlier. Yeah,
they've been pretty robust up to this point. I do think that some of the protectionism, whether it's taking place already in Mexico or whether it's just a looming risk, I do think that those risks will help to keep a little bit of volumes at bay. And what I'm noting there is Europe is already in the process of doing an investigation on Asian stainless. And I think it's probably just I really think it's an if, not a when, or sorry, it's a when, not an if, that the United States may follow suit if they continue to see that taking place. Because one stat that was thrown out just a couple of days ago by the CRU was their estimate today is that North American stainless mills are currently operating at only 65 to 70% capacity. And one of the arguments for that is because there's so much import penetration that there's no need for domestics to ramp up any more than that.
Wow. Okay. And finally, recent price increase from Cliffs, what kind of impact has that had on the market?
Yeah, sure. So I alluded to this a little bit, maybe a couple minutes ago. Cliffs has been, to my knowledge, Cliffs has been the only one that officially put out an announcement, and their announcement was not a hike per se. It was more here's the line in the sand. It's at $750. If you have any inquiries, come to us, let us know. No other mills followed suit, but as I mentioned, if you went to a domestic mill today and tried to negotiate a spot steel buy, you're not going to get pricing that's going to be reflected by the CRU. The CRU just yesterday came in at 663. that price I would say is no longer available in the market. For that reason, we'll probably in the coming weeks see the CRU begin to reflect the spot transactions going up. So I guess the direct answer would be the impact on the market seems to be real. I think it's being aided by the fact that a lot of these big mills are taking temporary outages, helping to better balance supply demand conditions. And I think there's some room for prices to move back higher. And I think that gets aided additionally if and when the auto workers strike gets pushed to the background.
Well, great stuff as always, Nick. Jam-packed show. A lot of questions coming in, so thank you from the audience. Any closing thoughts? We're looking at a Bears win tonight, maybe, so maybe they'll move into your bubble next month of teams that have won. I also saw something that in the past year, Queen Elizabeth, who passed away a year ago, right, has seen more wins in the past year than a Bears win, right? She hasn't missed she hasn't missed many Bears wins or something like that. It's something to that degree. So there's a lot of memes all over. But what are your takeaways here for the month?
For the viewers, I've already gone on and I've spilled my guts, spilled my brain over the last hour. So I think people probably had enough. I'll share a quick anecdote to keep it light. A lot of my friends say that I'm a sports jinx, although I may or may not be true. Jury's still out on that. But to the extent that I am a sports jinx, there might be a little bit of tailwinds behind this Bears team now that I've made fun of them publicly on Cup of Joe. So I'm feeling good about tonight. This is not gambling advice. This is not betting advice. But I think this might be the contradictory support that the Bears really need to get over that hump tonight.
Well, you heard it, everybody. Put your money on the Bears right now. Please don't. That was a legal disclaimer. Nope. Do not do that.
Thank you, everybody. And
thank you, everybody.
We'll be back at it next month.
See you next month. Thanks, Nick.